Bull versus bear market. Which way is the market headed? And how can you understand its direction? In the silence of the night, a phone screen glows. In someone's portfolio, green is running across the screen. In someone else's account, red marks are spreading. On one side, people are saying, now the market will turn into a rocket. While on the other side, someone is nervously asking, is everything about to fall? This is where the fear begins, because the stock market is never just a game of numbers. It is also a game of hope and fear. And this is where curiosity is born. Where is the market really headed? Is this the beginning of a rally or a trap of decline? The person who understands this direction does not run after every noise. The one who does not understand it often ends up reaching the wrong turn along with the crowd. The biggest truth of the stock market is that it never moves in one straight line. Sometimes it climbs upward slowly, sometimes it suddenly breaks down, sometimes confidence remains strong for months, and sometimes one small piece of news changes the entire sentiment. To explain this rise and fall, two words are used the most all over the world: bull market and bear market. According to SEBI's investor education material, a bull market is a phase when stock prices are in a rising trend and investors remain optimistic, while a bear market is a phase when prices fall and investors become pessimistic or fearful. In other words, the real difference is not just in price movement but also in mindset. If you understand a bull market in simple language, it is that phase when hope keeps increasing in the market. People start believing that the economy is strong, companies are increasing their earnings, the future looks better, and that is why people become more willing to buy stocks. Even if there is a decline, buyers return quickly. That is why in a bull market, every correction starts looking like an opportunity to many people instead of fear. According to Investopedia, broadly, a bull market is a phase of rising prices and sustained optimism. Many analysts use the convention of a 20% rise, meaning that when a major index shows a steady recovery of around 20% or more from its recent low, it is considered a bull market. But it is important to remember that this is not a legal or fixed government definition, but a market convention. Now understand a bear market. This is the phase when confidence in the market starts weakening. People begin avoiding risk, prices remain under pressure continuously, rallies lose strength, and every recovery sees selling pressure return. According to both Britannica and Investopedia, a bear market is usually seen as a phase of around 20% or more decline from a recent high, especially when that decline continues for some time and sentiment remains negative. A bear market does not mean only that indices are down, it also means that the psychology of investors has changed. People begin thinking not about returns but about protecting capital. But the real game begins here. Many people think that the 20% number is everything. As soon as the market goes up 20%, it is bull. As soon as it goes down 20%, it is bear. The truth is that the market is far more complex than that. The 20% rule is an easy thumb rule so that investors can broadly understand market phases. But to identify the real trend, numbers alone are not enough. You also have to see how long the move has been going on, what the breadth looks like, how sectors are behaving, what the economic signals are saying, and in which direction sentiment is moving. This is where understanding the difference between correction, rally, and trend becomes important. According to Investopedia, a correction is generally considered to be a decline of around 10% from the peak, which can be short-term and does not necessarily mean a bear market. In the same way, even inside a bear market, sharp rallies can come, which many people mistake for a new rally, while in reality they are only temporary relief. On the other hand, even inside a bull market, declines of 5%, 8%, or 10% can happen. That is why it can be dangerous to make a judgment just by looking at 1 week's rally or 1 month's decline. So then how do you understand the market's direction? The first signal is the price trend. If major indices have been making higher highs and higher lows for many weeks or months, if buying is coming in on declines, and the market overall looks resilient, then this may be a sign of a bull phase. If indices are making lower highs and lower lows, rallies are failing quickly, and the broader market is staying weak continuously, then this points toward a bear phase. In technical language, this is trend analysis, but in the language of the common person, it simply means this. After every shock, is the market recovering, or after every attempt, is it breaking down again? The second big signal is sentiment. In a bull market, people feel hopeful about the future. Excitement rises around IPOs, new listings, risky themes, small caps, and mid caps. In a bear market, that same crowd starts disappearing. Media headlines become fearful. Questions like how much more will it fall start increasing, and investors begin looking towards safer assets. Even in Britannica's explanation of the economic cycle, the tendency during the contraction phase to move towards safer options like defensive sectors, bonds, and cash is mentioned. In other words, fear and greed are not just dialogues, they are real drivers of the market. The third signal comes from the economy. A bull market usually remains strong when corporate earnings are better, liquidity is supportive, business confidence is good, and the broader growth story looks positive. A bear market usually becomes deeper when recession fears, earnings slow down, inflation pressure, high interest rates, or geopolitical shocks begin breaking sentiment. However, it must also be remembered that the stock market moves ahead of the economy. That means many times the market starts falling when the economic data still looks fine, and many times recovery begins when the headlines still look frightening. That is why a smart investor does not look only at GDP, inflation, or company results. He also looks at market breadth. Breadth means whether only a few big stocks are pulling the index upward, or whether there is broad-based participation. If in a bull run only a handful of stocks are running while the rest of the market is weak, then the rally is not considered very healthy. On the other hand, if during a market recovery sectors start rising across the board, then confidence feels more genuine. The common investor often ignores this detail, but it helps a lot in understanding the trend. Now the question comes, where does the retail investor make mistakes? The biggest mistake is that in a bull market, he forgets risk, and in a bear market, he forgets opportunity. When a rally is going on, people start running only after momentum, forgetting quality and valuation. They start feeling that the market will always keep going up. This same overconfidence later gives pain to many portfolios. On the other hand, in a bear market, people start believing that now recovery will never come. The same good companies that were bought in the bull phase by calling them expensive are sold in the bear phase out of fear. This emotional cycle both creates wealth and destroys it. What should the strategy be in a bull market? First of all, it should be understood that even a bull market is not endless. In a rising market, disciplined asset allocation is the biggest protection. If the portfolio has become too equity heavy too quickly, then rebalancing can be a wise move. Profit booking does not mean leaving the market. It means keeping risk under control. Even in a bull market, a long-term investor should keep a portfolio where quality, diversification, and patience remain intact. Jumping into weak stocks or hot themes just because everyone is buying often becomes expensive later. A bear market demands exactly the opposite psychology and strategy. In times of fear, cash feels valuable, but quality businesses can also become available at better valuations at that same time. So a bear market is not always just another name for loss. According to Investopedia's bear market overview, bear phases are a historical part of the market cycle, and recoveries have also come after them. For long-term investors, a bear market can become a phase of disciplined accumulation, provided they focus on fundamentally strong assets and do not put everything at stake all at once. A disciplined approach like SIP can be especially useful in such times because it smooths timing risk to some extent. One more important thing here. Not every bear market turns into a recession, and not every bull market lasts forever. According to Investopedia's historical analysis, not all bear markets in US market history were linked to recessions. This means that market cycles are often linked to the economic cycle, but the story is not the same every time. That is why ready-made formulas do not work. An investor needs not rigid prediction, but flexible understanding. If you are a beginner, then to understand the market's direction, there is no need to start with very advanced indicators. First, see in which direction the major index has generally been moving over the past few months. Then see whether recovery on declines is strong or weak. Then listen to what the market narrative is. Growth, earnings, optimism, participation, or fear, slowdown, uncertainty, capital protection. Then ask your own portfolio. Am I investing by understanding the trend or reacting after seeing headlines? These small questions are the real beginning of market understanding. And perhaps the biggest lesson is this: bull and bear markets are not stories of animals, but of human behavior. A bull market gives us confidence, but many times it also gives complacency. A bear market scares us, but many times discipline and opportunity also come from there. That is why understanding the market's direction is not just about reading charts, but also about understanding human nature. The investor who learns that not every rally is permanent and not every decline is final gradually becomes mature. In the end, the matter is very simple. If the market is moving upward, optimism is broad, dips are being bought, and confidence remains strong, then this may be a bull phase. If the market is weak, rallies are not sustaining, fear is rising, and risk-taking is falling, then this may be a sign of a bear phase. But a smart investor does not make decisions on the basis of one day, one headline, or one candle. He looks at the trend, looks at sentiment, looks at the economic picture, and then shapes his strategy according to his goals. Because understanding the market's direction is not about predicting the future. It is about making your decisions better. If this video has taught you something new, or if you feel this information should reach more people, don't forget to like and share the video. Your small share can become valuable and useful information for someone else. If you have any questions related to this topic, or if you would like to share your opinion with us, be sure to write in the comment box. We read every question and suggestion from you, because your feedback inspires us to create better content. And if you want to keep receiving such interesting and reliable information about business, the economy, and the world in the future, then don't forget to subscribe to our channel GRT Business And also press the bell icon so that you get notifications of every new video directly. At GRT Business, we always strive to provide you with accurate, balanced, and reliable information. Our news and analysis are prepared based on information obtained from various news agencies, public sources, and public opinion. We make every effort to verify and validate each fact as much as possible. But in case of any possible error or dispute, the responsibility lies with the respective sources. Our only aim is to present you with a correct and trustworthy perspective so that you can understand any topic better.